When buyers are actively on the lookout for homes, they primarily source their information regarding home prices from the current list prices of the homes they see in the market. All other data is historical based on what buyers agreed to pay weeks or even months ago. Here's what catches their attention when they review the current MLS active listings here in the Phoenix Metro. First and foremost, they observe that the average price per square foot is higher in week 34 of 2023 than in week 34 of any year dating back to 2015. Furthermore, it's evident that every subsequent year has surpassed the previous 1 week in week 34. The market turbulence in the second quarter of 2022, triggered by a sudden surge in mortgage rates, which we all felt, turned out to have only a transient impact on what now appears to be a minor hold and a fleeting significance. Currently, the average price per square foot for all active listings stands at $350.27. This average encompasses all areas within the MLS database and all types of dwellings. Due to the ample size, really big, the data in this chart exhibits a very well-defined pattern, revealing the following insights. Number 1, the long-term trend has consistently risen over the past 8 years, with 2023's numbers being approximately 91% higher than in that of 2015. Number 2, summer typically experiences a seasonal dip, marked by declining figures from May to August. An exception is noted for 2020, which rebounded from the significant disruption of the in March and April of that year. And number 3, the third quarter of 2023 is mirroring the behavior seen in the third quarter of 2015 through 2018, years that were relatively normal and uneventful in terms of pricing trends. Currently, active list prices are 8.7% higher than they were at the same time last year, a more substantial increase compared to the 6% growth measured during the equivalent period the previous year. Notably, last year experienced an unusually swift notable decline between May and August. We all remember that roller coaster ride, compounded by seasonal weakness. This was primarily influenced by the actions of iBuyers, who continued buying even as the market cooled, leading to an excess inventory situation by June of 2022. Consequently, they initiated fire sales, all of this inventory during the later half of 2022 to mitigate their exposure to the market. A significant issue lies in the fact that the reality we have been talking about is in stark contrast with the exaggerated narratives propagated by the sensational and misguided commentators on platforms like this one, YouTube, and other social networks, as well as even more serious analysts associated with institutions like Goldman Sachs earlier this year. If potential buyers have been consuming this content, they may come to the market with misconceptions that diverge significantly from reality. You see, buyers anticipating a decline in prices are likely to find themselves, disappointed, especially when they consider that actual prices alongside the latest 30-year mortgage rates will stand at around 7.4%. This contributes to the persistent weakness in demand this year. It's worth noting that a common misconception is that weak demand inevitably leads to lower prices, when in fact, it translates to subdued sales. For prices, the equilibrium between supply and demand is pivotal. While supply has seen a slight uptick in recent weeks, its overall levels remain well below the norm. A minor increase is unlikely to have a substantial impact. Achieving market balance would necessitate a near doubling in supply. As always, thank you for watching. If you got any value out of this video, it'd really help if you hit that like button. If you want to see more content like this, hit the subscribe button. And let's go ahead and close this out with our speedometer for the Phoenix market area. And as always, that's with the Cromford Market Index. So what we're looking at here is this year's rise from the ashes of the fall last year. Now let's throw 2022 here on the graph. You can see we came from way in the crazy stratospheric seller's market down into balance and down into a tiny buyer's market right here. This year we've come up and we've basically balanced out right here, where supply and demand are really arguing with one another. There's not enough supply, and yet demand continues to go down equivalently. With that, let's go ahead and take a look at our speedometer and kind of put that into perspective. Here is that speedometer. You see here in the middle the market index. That represents whether we're in a buyer or seller's market. 90 to 110, that's balance. Above 110, here in the green zone, that means that we're technically in a seller's market. Supply over here on the other side is green, which means good for sellers, not so good for buyers. We are at 48% of normal, and demand over here at 76.9% of normal. If we see demand continue to fall, our market index will fall with it, unless supply falls at the same time. These are all correlative to one another. So I hope you guys stay safe out there. Again, if you liked the video, hit that like button. If you disliked it, go ahead, hit the dislike button. Just tell me in the comments why. I'd love to make these better so that you get the information you need. Look forward to seeing you in the next video.